Welcome to Private Asset Management's second quarter update to our 2018 economic and financial market outlook. The views and opinions expressed herein are as of the date recorded and should not be construed as an offer to buy or sell any securities. Such views and opinions may differ from those of Private Asset Management or its affiliates and are subject to change without notice. Private Asset Management has no obligation to provide updates or changes. U.S. economic growth slowed in the first quarter as personal consumption made a smaller positive contribution in the period than it has in recent quarters. Based on data released so far in the second quarter, we believe the U.S. consumer has reasserted itself as the driver of the U.S. economy. The Retail Sales Control Group, which excludes food, automobiles and parts, gasoline, and construction materials, is a good proxy for the personal consumption category of GDP. As shown here, before a flat reading in June, Control Group retail sales saw a 4-month period of increasingly strong growth. We believe this data will translate into a stronger contribution from the U.S. consumer when second quarter GDP data is released on July 27th. Two economic topics dominated the conversation in the second quarter. The first was the U.S. Treasury yield curve. The yield curve continues to flatten as short-term interest rates rise faster than long-term rates. Shown here is the spread between the 10-year and the 2-year U.S. Treasury. An environment when the spread becomes negative is called a yield curve inversion and has been a reliable indicator of an upcoming U.S. recession. The dynamics that underlie the flattening yield curve are helpful in estimating the timing of a possible yield curve inversion. Since the final Federal Open Market Committee meeting of 2017, policymakers have increased the target Fed funds rate by 25 basis points these 3 separate times. Those 75 basis points of increases in the Fed funds rate have translated into just a 62 basis point increase in the 10-year Treasury yield, while the 2-year Treasury yield has increased 90 basis points over the period. The relative sensitivities of these yields to changes in the Fed funds rate have contributed to the flattening of the yield curve. For each basis point increase in the Fed funds rate, the 10-year, 2-year spread has fallen by about 0.4 of a basis point. Moreover, with 50 basis points of Fed funds rate increases still expected in 2018, we may approach a yield curve inversion by the end of the year. While we expect the yield curve will continue to flatten in the second half of the year and possibly invert, we note that surveys of economists do not reflect this expectation. The second dominant topic in the quarter was international trade, specifically the trade barriers put in place or threatened by leaders around the globe. The trade war between the U.S. and China is of particular interest because of their size and impact on the global economy. Combined, the U.S. and China account for 24% of global exports and 26% of total imports. The trade relationship between the two countries is also extensive. Both are each other's largest export market. Some 16.4% of U.S. exports were destined for the Chinese market, while 21.8% of Chinese exports landed on U.S. shores. While there is potential for further escalation, the tariffs actually imposed by the U.S. on Chinese goods is small relative to the total value of Chinese exports to the U.S. Still, the impact of this trade war is beginning to ripple through the global economy. China has enacted policies that increase leverage in an attempt to stimulate growth, while a recent survey in June showed that high-income U.S. consumers are increasingly concerned by the trade war, which may be reflected in their spending activity in the second half of the year. We remain hopeful that policymakers in each country will re-enter negotiations and try to find a compromise, as the U.S. and the EU did in late July. Turning our attention now to financial markets, total returns in the second quarter continue to show favorable results for small and mid-cap companies who are more likely to be domestically focused and therefore insulated from the trade war. On the other hand, international markets suffered in the quarter as the two largest global economies waded into a trade war. S&P 500 sector returns showed a continued rebound in energy, which benefited from rising oil prices during the period. Sectors that are more exposed to international markets and global economic activity, such as industrials, materials, consumer staples, and financials, underperformed in the quarter. Valuations generally look more attractive at the end of the second quarter. Strong earnings growth across S&P 500 sectors remains our expectation, which has brought the index's forward price-to-earnings ratio back below its 75th percentile. Fixed income returns were similar to those seen in the first quarter. The corporate high yield space is the only category to post positive year-to-date returns through the end of the second quarter. The high yield space has benefited from being relatively low duration in the prevailing rising interest rate environment. The high duration investment grade corporate space is the worst performer so far this year. Thank you for joining us.